September 3, 1929. The Dow Jones Industrial Average hits 381. The crowd cheers. The newspapers declare a permanent plateau of prosperity. But in the back room of the Federal Reserve, a dusty ledger reveals a terrifying secret that the men on the trading floor are ignoring. The money has stopped flowing. Precisely 48 days later, the market didn't just fall, it evaporated. It wiped out an entire generation's wealth in 72 hours. History books tell you it was a random panic. They are wrong. The crash of 1929 was mathematically inevitable. 6 months before Black Thursday, a specific silent signal flashed on the charts, a divergence so massive that it guaranteed a collapse. Fast forward 97 years, nearly a century later in 2026. Amidst the noise of AI hype and algorithmic trading, that exact same signal just flashed again. For the first time since the Great Depression, the S&P 500 and global M2 money supply has broken. We have entered the Great Divergence. While stock prices are punching through all-time highs, the actual liquidity fueling the system, the real money, is crashing. We are currently witnessing the largest gap between asset prices and economic reality in human history. But the signal isn't just technical. Look around you. The fundamental warning lights are blinking in unison, exactly as they did in the Roaring '20s. We have a consumer who is drowning in debt, using buy now, pay later schemes to buy groceries, mirroring the installment craze of 1929. We have a Federal Reserve that has kept rates higher for longer, mistakenly believing the economy is invincible, just as they did in the summer of '29. And we have a retail mania where shoeshine boys are giving stock tips, except today they are TikTok influencers pumping zero-day options. The algorithm of the Great Depression has been re-triggered. The gap has opened, and just like in 1929, the world is too busy counting its paper profits to notice that the floor has already fallen out. Welcome to the crash that nobody sees coming.
To understand why 2026 is about to break the world, you have to ignore the price of the S&P 500. The price is a liar. It is a hallucination caused by momentum algorithms and passive ETFs. Instead, you must look at the fuel tank. In economics, the fuel is called M2 money supply. M2 is the total amount of cash, checking deposits, and liquid assets in the system. It is the oxygen of the economy. For the last 15 years, the rule was simple. When M2 goes up, stocks go up. The Federal Reserve printed money, and that money flowed into assets. It was a direct correlation. But in late 2025, something broke. Look at this chart. Since the start of 2024, the global M2 money supply has been flatlining. Central banks around the world, terrified of a second wave of inflation, have tightened the taps. The liquidity has dried up. The fuel tank is empty. Yet, look at the S&P 500 in January 2026. It is vertical. This phenomenon is what financial historians call a melt-up. It happens when investors stop caring about math and start trading on pure belief. In 1929, they bought Radio Corporation of America at 73 times earnings because they believed radio was the future. In 2026, they're buying AI stocks at 90 times earnings because they believe intelligence is the future. The narrative changes, but the math does not. When stocks rise while liquidity falls, it creates an air pocket. The market is rising on fumes. There is no real capital supporting these valuations. It is a skyscraper built on quicksand. In 1929, this divergence lasted for about 6 months. It fooled everyone. Even the smartest economists thought the old rules didn't apply anymore. But gravity always wins. When the gap finally closed in October 1929, the market didn't just correct, it crashed 89%. Today, the gap is wider than it was in 1929. The liquidity gap currently sits at a record deviation. This means one of two things must happen. Option A, the Federal Reserve immediately prints $5 trillion to fill the hole, which would trigger hyperinflation. Option B, asset prices collapse by 40 to 50% to reconnect with reality. There is no middle ground. The rubber band has stretched too far. And while Wall Street is celebrating the new highs, the bond market, the smart money, is already screaming fire. But M2 is just the technical trigger. The real bomb is hiding in the wallets of the American consumer. Because just like in the 1920s, the prosperity you see on Instagram is being funded by a mountain of debt that is about to collapse. If M2 money supply is the fuel of the markets, the consumer is the engine. And right now, the engine is running on fumes. To understand the crash of 1929, you have to look beyond the stock market. You have to look at the living room. The 1920s was the first decade in human history where debt became fashionable. For the first time, Americans could buy radios, cars, and washing machines on installment plans. It was a revolutionary concept: enjoy now, pay later. It created an artificial boom. Factories produced record amounts of goods because they thought Americans were rich. But they weren't rich, they were just leveraged. Now look at January 2026. The installment plan has mutated into something far more dangerous: buy now, pay later, BNPL. In the 1920s, people went into debt to buy a Ford Model T, a long-term asset. In 2026, data shows that millions of consumers are using BNPL services to buy groceries, fast food, and gas. Let that sink in. We have an entire generation financing a sandwich over 4 weeks. This isn't strong consumer demand, as the media tells you. This is desperation disguised as commerce. The U.S. credit card debt has now shattered all previous records, sitting well above the trillion-dollar mark, with interest rates averaging over 22%. The personal savings rate, the buffer that protects families from disaster, has collapsed to near-record lows. Why does this matter? Because of the wealth effect. In Chapter 1, we talked about the stock market melt-up. When people see their 401k or their crypto portfolio hitting all-time highs, they feel wealthy. They stop saving. They book the expensive vacation. They buy the new car. They assume the line will go up forever. This is exactly what happened in the summer of 1929. The consumer was tapped out, but the stock market gains kept the spending alive. It was a hallucination. Today, we are seeing the same consumer cliff. Delinquencies on auto loans and credit cards are spiking to levels we haven't seen since the 2008 financial crisis. The consumer has hit the mathematical limit of their credit card. The moment the stock market turns, even by 10%, the wealth effect will flip into the reverse wealth effect. Suddenly, the debt looks terrifying. The spending stops instantly. The vacation is canceled. The car is returned. When consumer spending stops in an economy that is 70% consumption-based, corporate earnings collapse. And when earnings collapse, the stock market, which is currently priced for perfection, has no floor. In 1929, when the installment bills came due, the factories shut down because nobody could afford the products anymore. In 2026, the consumer is walking toward a cliff edge, blindfolded by the glare of a rising stock market. But here is the tragedy. The one institution that is supposed to prevent this, the Federal Reserve, is actually the one pushing us off the edge.
In the summer of 1929, the Federal Reserve made a catastrophic calculation. They saw the stock market speculation, the radio stocks, the margin loans, the euphoria, and they decided they had to stop it. They wanted to pop the bubble without killing the economy. So they tightened monetary policy. They raised the discount rate to 6% in August 1929. They choked off the credit. On paper, it looked like the responsible thing to do, but in reality, it was a death sentence. Why? Because the real economy had already started to slow down months earlier. Manufacturing was already dipping. Auto sales were already cooling. By raising rates into a slowdown, the Fed didn't just pop the bubble, they turned a recession into a depression. Fast forward to January 2026. Jerome Powell and the Federal Reserve have just replicated this error with terrifying precision. For the last 2 years, the Fed has been fighting a war against inflation. They raised rates at the fastest pace in history and held them there, chanting the mantra, higher for longer. They told us they were data-dependent. But here is the problem with being data-dependent. The data is always old.
Economic data is like looking at a star in the sky. You are seeing the light from the past, not the present. When the Fed looks at employment numbers or CPI, they are looking at what happened 3 months ago. They are driving the car by looking exclusively in the rearview mirror. This leads us to the most dangerous concept in central banking, the lag effect. When the Fed raises interest rates, it doesn't hurt the economy immediately. It takes 12 to 18 months for the pain to travel through the system. It's like turning the shower handle to hot. The water stays cold for a minute, so you keep turning it. Then suddenly, you get scalded. In 2026, we are finally feeling the scalding water from the rate hikes of 2024. Remember the liquidity gap we discussed in Chapter 1? That gap exists because the Fed kept tightening even as the money supply collapsed. They drained the system of liquidity to fight the ghost of inflation, ignoring the fact that the consumer, Chapter 2, was already drowning. Now, the Fed is in a trap of its own making. If they panic and cut rates aggressively now to save the economy, they risk reigniting inflation, the 1970s outcome. If they stay the course to ensure inflation is dead, they guarantee a deflationary bust, the 1929 outcome. History shows that central banks always overstay their welcome. In 1929, they stayed tight too long. In 2008, they waited until Lehman Brothers collapsed to panic. In 2026, they are once again behind the curve. The market believes the Fed will save them. They believe in the Fed put, the idea that Powell will print money the moment stocks drop. But look at 1929 again. The Fed tried to cut rates after the crash. It didn't work. Why? Because once the psychology breaks, cheap money doesn't matter. You can lead a horse to water, but you cannot make him drink. You can give banks cheap cash, but you cannot force them to lend to a bankrupt consumer. We are watching a slow-motion car crash where the driver thinks he is still on the highway. The policy error has already been made. The ink is dry. The lag effect is hitting right now. And this creates the perfect setup for the next phase of the disaster, the phase where logic completely exits the building and the market enters a state of delusional euphoria right before the end.
3 days before the world ended in 1929, Irving Fisher, the most respected economist of his generation, stood before a crowd and made a prediction that would ruin his legacy forever. He said, "Stock prices have reached what looks like a permanently high plateau." He wasn't trying to scam anyone. He genuinely believed it. His logic was seductive. He argued that the new technologies of the 1920s, electricity, the radio, the automobile, had fundamentally changed the laws of economics. He believed productivity was so high that the old cycles of boom and bust were obsolete. Does that sound familiar? It should. Because if you turn on the financial news in January 2026, you are hearing the ghost of Irving Fisher speaking through the mouths of tech analysts. Instead of electricity, the word is artificial intelligence. Instead of radio, the word is quantum computing. The narrative is identical. This time is different. They tell us that AI will create infinite productivity. They tell us that valuations of 100 times earnings are justified because the total addressable market is the entire galaxy. They tell us that a recession is impossible because the algorithms are too smart to let it happen. This is the psychology of denial. History teaches us a brutal lesson. The crowd is most bullish at the exact top. The optimism reaches its peak precisely 1 second before the floor collapses. Why? Because by the time the market hits the top, everyone who wants to buy has already bought. There is nobody left to recruit into the Ponzi scheme except the absolute last fools. In 1929, the shoeshine boys were giving stock tips to bankers. In 2026, we have finfluencers on TikTok telling teenagers to leverage their student loans to buy zero-day options on tech stocks. It is the final stage of the mania. It is the rationalization of greed. When you are making money effortlessly, your brain invents reasons to ignore the danger signals. You look at the liquidity gap, Chapter 1, and say it doesn't matter. You look at the consumer cliff, Chapter 2, and say it's manageable. But watch what the insiders are doing, not what they are saying. In the months leading up to the 1929 crash, the smart money, the Rockefellers, the Kennedys, quietly exited the market. They sold their shares to the retail public and moved into cash and gold. Look at the filings from late 2025. The CEOs of the biggest tech companies in the world have been selling stock at a record pace. The billionaires are cashing out while telling you to buy the dip. They are handing you the bag. The psychology hasn't changed in 100 years. We are biologically wired to follow the herd off the cliff. So, we have the technical signal, the divergence. We have the fundamental trigger, the consumer. We have the policy error, the Fed. And now we have the delusional psychology, the denial. All the ingredients for the perfect storm are in the pot. The only thing missing is the spark, the match that lights the fuse. And unlike 1929, when the selling started, it was humans screaming on a floor. In 2026, the selling will be done by machines at the speed of light.
In October 1929, the crash took time. It was a manual process. A broker on the floor of the New York Stock Exchange had to physically receive a sell order, find a buyer, shout a price, and write a ticket. The panic unfolded over days. It gave people time to think, time to pray, and time to react. In 2026, you will not have that luxury. The next crash will not happen at the speed of human thought. It will happen at the speed of fiber optic light. We have built a market structure that is fundamentally fragile, relying on two dangerous pillars that did not exist in 1929: passive investing and zero-day options. Let's start with the passive trap. In the 1920s, individual investors picked individual stocks. If Radio Corp crashed, maybe General Electric stayed stable. Today, over 50% of the U.S. stock market is held in passive index funds and ETFs like the SPY or VOO. This sounds safe, but it has created a terrifying systemic risk. When you buy an ETF, you are putting the market on autopilot. The algorithm blindly buys every stock in the index, regardless of price or value. It pushes valuations up indiscriminately. But here's the nightmare scenario. What happens when the autopilot switches to reverse? Imagine a crowded theater with a single exit door. In a normal market, people leave one by one. In a passive market, everyone is handcuffed together. When the selling starts, the ETF algorithms don't ask questions. They sell everything. Apple, Microsoft, Amazon, it all gets dumped simultaneously to meet redemptions. This creates a liquidity cascade. In 1929, there were value investors waiting to buy the dip. In 2026, because everyone is passive, there are no active buyers left. Who steps in to catch a falling knife when the machines are programmed only to sell? The answer is nobody. The price gaps down into a void. But the passive trap is slow compared to the second accelerating agent, zero-day options. This is the casino inside the stock market. 0 days to expiration options are bets that expire within 24 hours. In 2026, these risky bets make up nearly half of all options volume. It is pure gambling. Retail traders and institutions use massive leverage to bet on tiny daily moves. Here's why this is dangerous. Market makers, the banks that sell you these options, have to hedge their risk. If the market starts to fall, the market makers are mathematically forced to short sell stocks to protect themselves. This pushes the market down further, which forces them to sell more. It's a negative feedback loop called a gamma squeeze. In 1929, margin calls triggered the selling. In 2026, algorithmic hedging will trigger a flash crash that could wipe out 20% of the S&P 500 before you can even log in to your brokerage account. We saw a preview of this in 1987, Black Monday, and 2010, the flash crash. But those were glitches. Today, it's the feature, not the bug. The entire market structure is built on leverage and speed. Think about the liquidity gap we discussed in Chapter 1. The market is rising on low volume, no real money. When the selling starts, that low volume means there is no market depth. You might try to sell your shares at $500, but the next available buyer is at $300. The air pocket we talked about will be filled instantly. In 1929, the market fell 12% on Black Tuesday. In the 2026 scenario, with algos, zero DTEs, and passive selling all triggering at once, we could see a drop that halts trading entirely. The circuit breakers, rules designed to pause the market if it drops 7%, 13%, and 20%, will be the only thing stopping the S&P 500 from going to zero. So do not expect a slow bleed. Do not expect a warning. The 1929 signal has flashed, but the 2026 execution will be instantaneous. One morning you will wake up, check your phone, and realize that the world has changed while you were sleeping. But when the dust settles and the algorithms finally stop selling, we will be left with a new reality. A reality where the fake wealth has evaporated and only the real wealth remains. This brings us to the most important part of this entire story, the great wealth transfer. Because in every crash, money is not destroyed, it is transferred. The question is, who is it being transferred to?
There is a fundamental law of physics that applies to economics. Energy cannot be created or destroyed, it can only change form. The same is true for wealth. When the stock market crashes, when the S&P 500 drops 50% and news anchors scream that trillions of dollars have been wiped out, they are lying to you. That wealth didn't disappear, it didn't vanish into the ether. It simply changed hands. This is the great wealth transfer, and understanding this dynamic is the difference between being a victim of the 2026 crash and being the one who profits from it. In 1929, the transfer was brutal but simple. The dumb money, the public, was leveraged to the hilt, holding overvalued paper assets. The smart money, the Kennedys, the Morgans, held cash and gold. When the crash happened, the public was forced to sell their homes, their farms, and their stocks at pennies on the dollar to cover their debts. Who bought them? The smart money. They swooped in like vultures and bought the United States of America for a 90% discount. They didn't just survive, they consolidated power for the next century. In 2026, the mechanism is the same, but the assets are different. We are facing a triple transfer. Phase 1, the liquidity crunch. Cash is king. In the first weeks of the collapse, the algorithm of collapse, everything will fall. Stocks, real estate, crypto, even gold. Why? Because in a margin call, you don't sell what you want to sell, you sell what you can sell. Hedge funds and retail traders will dump everything just to get US dollars to pay their debts. In this brief window, the US dollar will skyrocket. This is the trap. The average person will panic and think, I should have stayed in cash. But this phase is short. It is the eye of the storm. Phase 2, the response, the devaluation. Once the system breaks, the Federal Reserve will panic. They will see the liquidity gap widening and the economy imploding. They will have no choice but to pivot. They will cut rates to zero. They will restart the money printer, QE, on a scale that makes 2020 look like a joke. This is where the real transfer happens. They will flood the system with new, worthless dollars to bail out the bond market. If you are holding cash in Phase 2, you are the loser. You are saving a melting ice cube. The purchasing power of your savings will be stolen to pay for the bailout. Phase 3, the flight to hard assets, the new safe havens. This is where the smart money is already positioning in January 2026. They know the printing is coming, so they are moving wealth into assets that cannot be printed. Look at gold. In 1929, gold was money. In 2026, central banks around the world, China, Russia, India, are buying gold at record paces. They know the dollar system is mathematically insolvent. Gold is the only asset with zero counterparty risk. It is the insurance policy against the Fed's inevitable policy error. Look at Bitcoin. This is the wild card of 2026. For the first time in history, we have a digital store of value that exists outside the banking system. In the initial crash, Bitcoin might drop with tech stocks, but in Phase 2, when the money printer turns on, it is designed to be the fastest horse in the race. It is the digital gold for a generation that doesn't trust vaults. And finally, look at real assets, farmland,
energy, commodities, the things humans actually need to survive. The great wealth transfer of 2026 will punish the passive investor who holds a 60-40 portfolio of stocks and bonds, believing the past returns guarantee the future. It will destroy the consumer who is living on BNPL debt, but it will reward the patient investor, the person who is sitting on cash right now, waiting for phase one, the person who is ready to buy high-quality assets when there is blood in the streets, the person who understands that a crash is just a reset button on prices. Imagine being able to buy Amazon or Microsoft at 2020 prices. Imagine buying real estate at 2012 valuations. That is what a crash offers, but you can only participate if you are not the one being liquidated. So the question you need to ask yourself is not, will the market crash? The math says it must. The question is, which side of the transfer table am I sitting on? Are you the one who provides the liquidity at the bottom, or are you the one demanding it? Because when the dust settles, the middle class will be hollowed out, and the gap between the rich and the poor will be wider than ever before. This isn't fair, it isn't moral, but it is the reality of the system we live in. And this brings us to the final conclusion. The clock is ticking. The signal has flashed. What do you do tomorrow morning? We have spent the last 30 minutes analyzing the anatomy of a financial disaster. We have looked at the math of the liquidity gap. We have exposed the fragility of the consumer cliff. We have dissected the Fed's trap and the algorithm of collapse. The evidence is not just compelling, it is overwhelming. The signal from 1929 hasn't just flickered, it has been screaming at us for months. But all of this data, all of these charts are completely useless if you suffer from the most dangerous human flaw of all, normalcy bias. This is the psychological state that tells you, because the market didn't crash yesterday and it didn't crash today, it won't crash tomorrow. It is the voice in your head that says, they will print money, they will save us, AI will fix it. This is the exact same voice that whispered to the investors in October 1929. It is the same voice that comforted the homeowners in 2008. It is the voice of complacency. And in the financial markets, complacency is the precursor to slaughter. In 2007, just months before the global financial crisis, Chuck Prince, the CEO of Citigroup, famously said, "As long as the music is playing, you've got to get up and dance." He was dancing right up until the moment his bank collapsed and the world economy melted down. In January 2026, the music is blaring louder than ever. The AI hype is deafening. The stock market is throwing the wildest party in history. But if you look closely at the orchestra, the bond market, the money supply, the real economy, you will see something terrifying. They have already packed up their instruments and left the building. You are dancing to silence. The only thing keeping the rhythm going is the collective delusion of the crowd. So, here is the final warning. You cannot time the top. It is impossible. If you are waiting for the CNN headline that says "Market crash imminent" to sell your positions, you are already too late. In the age of algorithms, by the time the news hits your screen, the move is over. You become the exit liquidity for the machines. The goal is not to predict the exact hour of the collapse. The goal is to survive it. Look at your portfolio. Look at your debt. Look at your exposure to the passive trap. Ask yourself, if the market closes tomorrow and doesn't open for 5 years, would I be okay? If the answer is no, you are gambling, not investing. The 1929 signal we triggered is not a probability. It is a mathematical certainty waiting for a catalyst. The divergence will close. The debt will be reckoned with. The transfer will happen. The window of opportunity to position yourself on the right side of history is closing. The signal has flashed. The alarm is ringing. History has given you the blueprint. The rest is up to you.